Hey team, welcome back everybody to the Dentist Who Invest podcast. This is a podcast that I did such a long time ago, and it's more than overdue that we need a refresher on it because things have changed so much in the background with how tax is designed, which is with how it's how it affects us as dentists in the UK, that we need a refresher, we need an update. So we're here today to talk about the age-old debate, the age-old argument, limited company versus sole trader. And I've got my main man, David Hossein, here in front of us today, who is going to be able to articulate very clearly his thoughts on the matter to get us dentists up to speed.
Thanks, James.
How are you today?
Very good. Thank you very much. You're all right.
Yeah, wonderful, mate. Hanging in there, hanging in there. In fact, what am I talking about? I'm thriving. I'm getting absolutely loads done these days, which is flipping great. A few big plans coming to fruition, which I'm really looking forward to. So, David, there'll be people who are listening to this podcast. Some will know who you are, and some are yet to meet you. So maybe it might be nice to do a little bit of an intro, so that people get to know you, basically.
Yeah, thanks. So we're a firm of dental accountants, and we do two main things. Firstly, as any accountant should do, your compliance work. So making sure you tick all your boxes. Have you done your tax returns? Have you met your filing deadlines and so on? The second kind of strand of what we do is working a bit closer with our clients. So we like to understand the journey that each of our client is on, what their personal circumstances look like, where are they in meeting their objectives, and what do they look like. So what's the plan for the next 5 years? Um, a lot of our clients are quite entrepreneurial, so they're either buying a practice, setting up a practice, um, buying properties and investments, or have already got established businesses and are looking at grooming those for sale. So how we like to work is I like to know everyone's circumstances and what they've got on the horizon, and then we keep in touch and check in on things that they need to plan and put in place for what the events are coming down the road, I suppose.
Top stuff. Cool. Well, let's jump straight in with the Sole Trader Limited Company podcast. So, David, once upon a time, well, actually, do you know what? I don't know why I said that. I almost said once upon a time it was really clear cut, but it's never been really clear cut at all. But now the boundaries have slightly shifted, haven't they? So, maybe if you just like to cover from a high level, Sole Trader versus Limited Company, how that works. Naturally, we all start out as sole traders and then we have to make the decision to become a limited company or not. Are you with me? So maybe it might be nice if we started from a sole trader, how that looks, and then maybe explore around about when do we start thinking about the limited company.
Yeah, that's absolutely great. We've got some slides. Would you be able to
Yes, I'll
open those?
share those just now. So there'll be two types of people who are listening to this. There'll be people who are listening to the audio recording on the podcast, and there'll be people who are watching the video on the Facebook group. So we will cater to both with our explanations. It's important to mention.
Yeah, thanks, James. So the slide does say associates, was what we say is also relevant to principals. That said, it's easier to become a company and not become a company as an associate, whereas a principal, you've often got contracts and bigger assets to move around. So, but the rates and numbers apply to both situations. So if we could have the first slide, please.
Sure.
Um, okay, so since July 2006, dental associates have been able to trade as a limited company, and the main reason that you'd think about doing something like that is it allows you to control the level of income you are taxed on. So that's the big difference between as a self-employed dentist, you are taxed on all of your income and profits, regardless of whether you spend them or not. Whereas with a company, you've got a good level of control over what you are taxed on because you can control what you draw from the company, which is then taxed as dividends. So as a general rule, the more you can leave in, the better things will be. Uh, that said, if you are in the NHS, whilst you can set up a company, you won't then be able to superannuate your earnings because that's just not an option available to associates, unfortunately. Principals can, but associates can't. So that's important to make clear as well.
Good stuff.
Yes. So how does it work? So in the UK, we've got different tax bands. So whether you fall into basic rate band, higher rate band, additional rate band, you'll be taxed at 20, 40, 45%. However, there is a bit of a quirk that once you go over 100,000 of profits, you start to lose your personal allowance. And that means that that chunk after 100,000 is taxed at 60% because it's taxed first at 40%, and then there's a clawback of the personal allowance, means that as you've got in the box there, if your taxable profits are 110,000, that £10,000 has a tax bill of £6,000 on it. So little things like that just make you think, well, if we had more control over how we're taxed, it gives you more flexibility to choose the rate of tax you want to pay. And certainly people want to avoid 60%.
100%. They do. Cool.
And in addition to that, so young families, clients who've got kids at nursery and so on, you are able to get £500 every 3 months, up to £2,000 a year for each of your child to help with the cost of that childcare. However, if your adjusted net income goes over 100,000 for either yourself or your partner, you don't get that benefit, and that's just taken away from you. It doesn't matter if you both earn 999,000. It's when one of you go over. So again, having the company and the option to adjust that can allow you to benefit from things like free childcare, which is quite helpful for small families.
And just to be super clear, who they're receiving that from is the government.
From the government, yeah.
Yes, awesome. Okay, so another incentive to stay under 100K of personal tax income.
Of personal tax, yes, yeah. Correct. Okay, so then next a bit about the procedures. So if it is right for you, first thing you got to do is choose a name. That can be anything, Dr. James Martin Limited. If you do want the name, the word dental in there, you have to write to the GDC, give them your GDC number, tell them why you want it. They will give you a letter which approves the use of the word dental because it is a protected term. That's then given to Companies House. They will release the name that you've requested, subject to somebody else not having it. That gets you your company name and articles. Beyond that, we then like to think about, well, what should the share structure be of that company? It is possible to involve your partner. So if you've got a spouse, say, who's got a lower income than you, and you want to shift some of your income over to them, use their lower rate tax band, that's also possible at the point you set the company up, and it can bring the tax burden down further. When assessing, is it right for you? We've got to consider a lot of different taxes, income tax, dividend taxes, national insurance, and corporation tax. The reason we wanted to do this podcast is it used to be much more clearer, but since the announcement in November, corporation tax has gone up. We do need to look at it again, and that's hopefully what we'll do today.
Awesome. Okay, let me get this next slide up.
So that's the kind of table of the taxes on each side. So as self-employed, you'll pay income tax 20%, 40%, 45%, and then national insurance 9.73%, and then class 2 at £3.45 a week. With a company, the first 50,000 is taxed at 19%, and that's the thing that's changed this year. So from April, profits above 19% are taxed at a marginal rate of 26.5%. So your actual corporation tax rate is a blend of those two figures. Okay.
Cool.
Beyond that, then when you draw money out, you then taxed on dividends at 8.75% for your basic rate band, 33.75% for a higher rate, and additional is 39.35%. You're going to blend those together for your calculation. If we look at the next slide.
Will do.
The next slide is just showing the assumptions before we show you the graph, how it used to look. So this graph, the next graph will assume that you've drawn all the money. Now, a lot of the planning that we do for Should Use a Company is based around the client being financially motivated to save to meet their objectives. And that could be saving for a deposit for practice or saving to invest in properties, shares, and so on. So, but we have to give advice on if you were to draw all the money, this is what it looks like. And that's that first line there. It's possible to extend the positive range, as we said before. If you get the spouse involved and they've got a lower rate of tax, it helps increase the savings. You can also do things like make pension payments and buy an electric car. Those are additional tax savings you can put through a company. The car tax relief on electric cars isn't available to self-employed people, so that's unique to having a company, and it's also you have to factor that in when you do your numbers. But anyway, getting past that.
Oh, interesting. Oh, that's interesting. Okay, cool.
Yes, so this is how it used to look prior to April, and you can see the line that's above the horizon. So up to 131,000, it was very clear that if you took all the money out, you're still going to be saving tax. But that tax saving, varies up to 2, up to 4,000. If you've got the spouse, add on an extra 20, 25 to 30% of savings, because obviously, you've got that saving there as well. There does come a point where if you take all the money, you were worse off. And that was before April. Now we've got the new rates, and what's changed since then? If you go to the next slide.
Sure. So, and we'll do that absolutely in 2 seconds. So, just for the benefit of those people who are listening, the graph that we can see up here in front of us, it displays a line which indicates whether or not you're better off withdrawing all of your wealth from a company, and it compares and contrasts if you're limited or if you're self-employed. So, what we mean by that is a sole trader or associate, right, David? Yeah.
Yes,
Yeah,
sorry,
yeah, yeah.
I forgot people are listening as well.
No, it's cool. It's cool. And this graph is really helpful. So obviously we're working totally under the assumption that you're withdrawing all the money straight out of the limited company, which very many people are to this level. But basically you're only actually better off. No, well, actually, beg your pardon. You become better off to remain self-employed or to remain as a sole trader when we get over the 131K mark. But prior to that point, apart from a very, very, very early phase up to the first 5,000, it looks like, you're better off to go limited. But it's of course important to remember that these are the old rules prior to April 2023.
Yes,
Have I
correct.
nailed that, David?
Yes, absolutely. Yeah,
Top stuff. Okay, let's move on to the next one.
yeah. So since well, in November, obviously the government announced the budget and the changes, and what's happened since then? So from April, the tax-free dividend allowance, which used to be £2,000, is now only 1,000. National insurance and dividend taxes have gone up by 1%. The big thing though that people are getting hit with now is that increase in corporation tax, where it used to be 19%, whereas you've got your profits above 50,000, the tax at 26.5%. That's a 7.5% real tax charge that people are incurring now. So what does that mean? So you process all that through to the calculators and so on, and now the graph looks like this. If we could see the next slide. So on here, I've done 2 lines. The blue one, which is a continuation of the orange one, is if you were to still draw all your money out, it starts to go down a lot sooner and more prominent as well. So that extra 7.5%, if you're drawing all the money out, there's a potential argument, subject to obviously pensions and car planning, that you need to look at that again. However, the people who are still winning are the people who are only drawing minimum amounts and saving money in the company, and that's the orange line, and that illustrates the tax saved if you're only drawing 50,000, which some of our clients like to do.
Interesting, right? And just for the benefit of those listening, the orange line, which displays how much tax you're saving whenever you're a limited company, this orange line, it's a little curvy and wavy in some parts, but it's pretty much consistently from the bottom left of the graph to the top right, meaning that there is a consistent saving the higher your earnings are, providing that you're only withdrawing 50K from your limited company for your personal spending. Is that about accurate?
Yeah, absolutely. It's the
Yeah.
one way the savings keep getting bigger and bigger and bigger.
So
Not everyone
makes
can live on
sense.
50K. We accept that, but somewhere between the 50 and 100 mark is going to give you a saving. So.
That's cool. So it still makes total sense despite the changes.
For those who save money in the company, yes.
Yeah.
But
Yes, 100%. And then the blue line, if you draw all of the money outside of the company, it makes more sense for you to be limited until about the 85K mark, it looks like. Then,
yeah, there's a little blip down and it comes back up again and goes down again.
yes, and then there's a small dip around the 100K mark. And then, actually, if you're spending around 120, 130, it begins to make sense for you to become limited again. But then after the 135 or so K, the 135K or so mark, then actually it makes more sense for you to remain sole trader if you're drawing all of the money from your company, if you're drawing the money out past that level.
Yes, and you've not got a spouse involved, and you've not done any other planning with the car. So it's a bit more nuanced, but we're trying to simplify for people. So
Yeah, 100%. And there'll be lots of this is the one thing that struck me about limited company versus sole trader at the very start whenever I was just grasping this stuff. I thought it was just really black and white. I was like, above this number it makes sense, below this number it doesn't, something like that, right? But it's actually not. There's a few caveats to it. So what we've done right now, what you've done, David, on this graph is made it dead simple, but we haven't actually chucked on top all of these other considerations that may change it on an individual basis, which is why I suppose it's helpful to have this conversation with your accountant.
yes, absolutely. Talk it through with your accountant. Sure.
Cool. All right, on to the next slide.
Yeah, the next slide just puts that into a tabular format. So if you wanted to see the exact figures, you can see that there. So if you start at 100,000, so if you've got profits of 100,000, you're only taking out 50, you're saving 6,300 in addition to the cash that's in the company. So that's certainly worth thinking about. When that figure gets higher and higher, so at 150, it's a net saving of 13,000 plus the cash that's in the company. So it was just for people to see. If you couldn't read the graph, that was why that slide's there.
Got you. And one thing that used to confuse me about this stuff a lot, it is important. If I've understood this correctly, this is your overall tax saving across you and your company, right?
Yes, company plus you, all taxes, that's the net effect of them.
Yeah, amazing. Yeah, so the net effect. Whereas I just thought that what I used to think back in the day was, until I had that articulated to me by someone, was I used to think that this was just the personal tax saving that I made, or the personal loss in tax that I made, as in that affected my money outside of the company, and within the company something else was happening. Right. I didn't actually realize like it was net overall. So it is important to mention that.
Yeah, absolutely. And as I say, we've tried to simplify it. We've got a very complicated spreadsheet that does 20 rows
Yeah.
and gives you each one, but just trying to make it clear. It's
Yeah.
total tax savings there.
Because dividends are after corporation tax, right? Which was
Correct.
another thing that I needed to learn to grasp this stuff. And there'll be people listening to this podcast and watching this video who are at all levels of their understanding of tax. So it is important to say that stuff out loud.
Yes, yeah, absolutely.
Okay, cool. Next slide.
Well, yeah, there are, as again, so other considerations, there's no kind of one answer fits all. You've got to talk to your accountant, but other things to think about are if you've got multiple businesses, that associated companies rule comes in. So the 250,000 is split over how many companies you've got. If they are associated. So if you own them, you're director shareholders of them, you've got to look at all companies together, and chances are you'll be paying more at 25 becomes more likely. Next point is what a lot of people are doing now is thinking, well, look, if I'm going to pay 26.5% on a big chunk of my company's profits, should I accelerate some pension contributions? And that is a bit of tax plan that you can do now. You've still got time to do that. Obviously, tax year ends 31st of March for corporation tax. Tax relief on cars, that's another tax benefit that's unique to the company. Companies can provide you with an electric car, and as long as it's new, you'll get a 26.5% saving on the full value of the car if you're buying it. If you're leasing it, it's on the lease payments, but if you're buying it and the company owns the car, that might be £50,000, 26.5% will come off your corporation tax bill. That's quite good. A lot of people are doing that. And I say that's not available if you're a sole trader. It's just for companies.
We should do a separate podcast on that at some point, and explain that in more detail. Something we can think about. Anyway.
Yeah, sure, can do. No problem.
Anyway.
Yeah, and then as I said before, you can also involve your spouse. I don't like to go over 25% because there are legislation and restrictions on income shifting, but at 25%, you're pretty much safe. It's just it has to be done in the right way as a gift of income, not ascribing for shares and incorporation. But that's a bit of a jargon that us accountants need to deal with. It's not too important for the listeners. However, another thing that is important is maternity pay. So if you are an NHS dentist and you're happy to lose the superannuation because your plans are such that your savings are going to be a replacement for the superannuation. If you are intending, or it's possible that kids could be on the horizon, I'd maybe wait until that's happened because you don't get as generous maternity pay. If you've gone as a company, you've got to lose most of it. So that's important to do as well, just to make sure you've thought that through.
Worth noting, yeah, definitely worth considering.
And as I say, take advice, talk to your accountant. If anyone's got any questions after that, more than happy to get in touch and see contact details there. So
cool, great stuff. Great stuff. Great stuff. Great stuff. Okay, let's just jump out of the presentation. I actually have a few more things that I'd like to ask as well. Is there anywhere that you can recommend any calculators that we can use online in which we can input our information and figure out where we'll be roughly or what we can expect in terms of tax?
Yeah, you absolutely can. The government's got self-assessment calculators, so that will give you the income tax if you stay as sole trader. If you want to do compared to a company, there is a website I found actually, but it's not a government one. They're not that helpful, unfortunately. They won't give you. But there's employed and self-employed.co.uk. That's quite a good calculator, and you just put your figures in, go to your accounts. What was my last taxable profit? Put that in, it'll tell you. But what it won't tell you is, by the way, if I want to save some money in the company, that's a bit more. The calculator can't do that extra step. Unfortunately, it is a bit of a manual task.
Yeah. What about software that charts our cash flow? Anything you can recommend on that front? That's what Xero does, right?
Well, Xero can do your cash flow, but you have to train it and feed it assumptions. How do I say this? So Xero is only as good as the information that comes into it.
Okay.
And it's quite rare that I would recommend our clients to do their own bookkeeping unless they've got sufficient time and leisure to do it. And then the point is, well, what benefit will it give you? A lot of our clients, in fact, the thing that tells them their cash flow is they look at the bank account and they ask us, how much is my tax this year? And they know that they've adjusted for that. That's on a very simple level. Obviously, I appreciate people have got investments and so on that they might need beyond that, but Xero won't give it you. You've got to pick up the phone and talk to your accountant, and it's a conversation.
Got you. Okay, cool. 100%. David, obviously, absolutely loads to take on board there today, which is great. Absolutely loads of information. The more, the better. Is there anything that you'd like to say on top that you feel might be relevant to anybody who's listening, or maybe we've very neatly created something there that summarizes everything?
Yeah, well, I think that your accounts and tax should be part of your financial plan. So I think people should have a financial plan, and that can be, I'm going to stay as I am and grow some cash savings. That can be, no, I'm going to look at investing in things, and that can be shares, that can be a practice, that can be a squat. And what's my retirement plan? So I think people should have a financial plan. As accountants, we can't give you financial advice on investments as we're not insured and regulated to do that. But talk to your accountant about your numbers and make sure you understand, well, how much do I need to spend? What are my monthly outgoings? Do I really need to draw it all? If not, if I had a company, the effect would be this. And that extra cash gives me options to do this. And over 10 years, it will allow me to do this. So it's important to talk to your accountant.
100%. Cool. All right. Well, David, I know that we talked just before we hit record, and you mentioned that you'd made a PDF for dentists. What's the name of that PDF?
Yeah, so ways to save tax as a dentist. And it is. So we don't get involved in any schemes at all. This is just things that are approved guidance. So investing in tax efficient VCTs, claiming all the allowances that you've got available to you. And it's a PDF, and we can put that out to people to download, and that's, free of charge.
Amazing. So yeah, awesome. And basically it just gives a breakdown of every single method that a dentist can use to legally reduce their tax bill, to manage their tax and be tax efficient is the terminology, right?
Absolutely.
Love that. Okay. And how are people best going about acquiring that? Contacting yourself?
Yeah, if that's you can drop me an email. I can also send it to yourself to distribute to people if they contact you as well. So
Sure. Okay, cool. So David Hossein, available on the group. That's Hossein, Hossein. And then what's your best email, David?
that's David at ortu.uk.
Top stuff. David, thank you so much for your time today. Super clear, super punchy, super impactful, concise summary of what we can expect in terms of tax as dentists and how we can make that decision about sole trader or limited company, which is really, really, really valuable. Thank you once again for coming along, and we'll get you back on the Dentist Who Invest podcast very soon.
Thanks, James. Thank you very much.